In this video, we're going to talk about home equity loans, which is essentially borrowing money against the equity that you have in your home. And this is also known as a second mortgage. So the formula for calculating home equity is pretty straightforward. Home equity is just going to be equal to the fair market value of your home, which if you've had an appraisal done, then you can use that as the fair market value of your home. And then you subtract out the remaining balance due on your mortgage. And when I say balance due, I'm talking about the principal that has yet to be paid, right? So the remaining principal, you're going to deduct that from the fair market value of your home. So for example, let's say that the fair market value of your home, you had it appraised, and it was, let me change colors here, let me use white. Let's say that it was $140,000. And then you said, well, how much do I have left? How much principal remaining on my mortgage to be paid? And you say it's $25,000 after you've checked it out. And so now that means that you have $115,000 in equity in your home. So if you think about your home and you just think about the claims against it, so we've got, here's your home, and so the home is worth $140,000, and then we've got over here the bank has a claim against 25,000 of that 140, and then you have a claim against 115,000, right? So this is your interest in the home, in the ownership of the home. This is your share at this point in time, however you want to think about it. So now you can use your share, your interest in the home, as collateral to get a second mortgage, right? You can now borrow against this and say, hey, look, I would like to borrow some money. And there's a couple different ways that you can do that. One way is just say, I just want a fixed rate lump sum loan, right? So just a fixed rate loan. For example, let's say that we're going to get into how you would go about calculating it, but let's say that you got a home equity loan of $50,000, and so you just had a fixed rate loan. You get a lump sum. I'll put that, it's a lump sum of money. The other one, which I'm not going to get into the second one a lot here in this video. I'm going to have a separate video on it. It's also a type of home equity loan, but it's called a home equity line of credit. And the home equity line of credit is actually just a revolving credit balance. So just say it's revolving, and I'll discuss that in another video. So right now I just want to drill down and focus on the basic vanilla home equity loan, a fixed rate loan that you're going to get by using the equity you have in your home as collateral. So now naturally you might be wondering, well, how much can I borrow? Right? So in our example before, we said, well, we have $115,000 in home equity. Does that mean that I can go and borrow $115,000 from the bank on a second mortgage? Well, not necessarily. So every bank does things differently, but I'm just going to give you kind of an idea how a bank might go about calculating how much the maximum you could get for a home equity loan. So first off, you start out with the fair market value of the home, and then the bank is going to have some kind of percentage rate. Some kind of rate at which they would be willing to make home equity loans. So they'll say, okay, well, look, assuming the house is worth $140,000, we would be able to loan lend up to 75% of that value after deducting the first mortgage that still has yet to be paid, right? So you take 75% of the fair market value of the home, and that's $105,000. And then you deduct out whatever happens to be the remaining balance on the first mortgage, right? So that comes out, in this example, to $80,000. That would be what the lender, and under this assumption, saying that they would be comfortable loaning 75% of the fair market value of the home after accounting for the first mortgage that's remaining to be paid, they'd be willing to lend up to $80,000. Now, again, a lot of this is going to depend on the lender in question, right? Sometimes you'll see lenders saying, hey, look, we'll lend you up to 125% of the value. In that case, you're going to be paying a very high interest rate, because that if you go above 100% of what the equity is, then obviously you're not going to be having any kind of collateral against it, and so the lender would charge you a very high interest rate to compensate for that risk. And then also it's going to have to do with your credit worthiness, what your credit what your credit score is, how good a job you did making the payments on your first loan. Now, something to think about when we think about kind of why you would do this home equity loan, and instead of just thinking, okay, well, obviously you need money, right? For some reason, you'd say, oh, it'd be great if I could tap into this. But what are maybe some benefits? And one benefit is that the interest might be tax deductible. And when I'm talking about tax deductible, I'm talking if you were to itemize. Right? So if you were to itemize on your taxes, just like your first mortgage, the interest most of the time is tax deductible on that first mortgage. Your interest on your home equity loan, that second mortgage, can also be tax deductible. But the IRS has some caps, and so the caps would be if assuming you are married filing joint, the cap would be up to the first $100,000 of your home equity loan. The interest on that could be tax deductible, and if you're married filing separately, then it would be a cap of $50,000. And then another restriction the IRS has is that the home equity loan has to be less than the fair market value of the home after reducing the fair market value by the home acquisition debt. Home acquisition debt, they're just talking about the loan, the first mortgage that you took out, right? So you deduct that from the fair market value of the home, and then the home equity loan needs to be less than that in order for the interest on it to be deductible. And another thing to think about too, and I probably should mention this earlier, when we talk about the cost of a home equity loan, obviously interest rate is one thing to think about, but you're also going to have to pay for things such as an appraisal, right? So if you go and you say, hey, I want a home equity loan, well, you need to know the fair market value of the loan for the lender to be able to compute, right? Remember, that's an input here, is they want to know the fair market value of the home to be able to compute your equity. So you're going to have appraisal costs and so forth. So it's not free to just say, oh, you know what, I think I'd like a home equity loan. But it might be advantageous. So we've got the deductibility and interest we just talked about here. So if you were to take that equity, right? So let's say you got this home equity loan for $80,000. Now, you could take that and you could pay down credit card debt. And that's what a lot of people do. They'll pay their credit card debt. A lot of households have significant credit card debt, and you might be paying 22% interest or something on credit card debt, and the interest that you're paying on credit card debt is not deductible, right? This is not deductible, and it's a really high interest rate compared to the interest rate that you might have if you were to tap into this equity on your home and say, hey, you know what, I want to borrow against the equity, and then I'm going to take that and I'm going to pay down this credit card debt, and then now I'll have a lower interest rate. So you'll have a lower interest rate, right? Because whatever the interest rate is on your home equity loan, rest assured it will probably be lower than your credit card interest rate, because credit card interest rates are very high typically. But if you could potentially get this lower interest rate, and you would have it even possibly being deductible. That's not the only thing that you can use a home equity loan for, obviously. Some people will do home repairs, or if they want to pay college expenses, tuition, things like that. These are the kind of things you can tap into to your home equity to be able to. You could even refinance if you want. But there's an important thing to remember when you do a home equity loan, and that's that you're giving up equity, right? So you've spent a long time building up equity in your home, and now you're borrowing this $80,000 against that equity. So it's like all the time you made those mortgage payments, and in the beginning so little was going toward your principal and so forth, and now you're giving up all that equity, and you're getting money in return. But now in terms of the equity on your home, you might be back to square one, right? So now you don't have that equity because you just borrowed against it. And so if you don't make payments, right, if you don't make payments on your home equity home, you could lose your home, right? Because you've lost the equity, and so that's a very important thing. You don't want to just look at it and just say, you know what, I'll just keep tapping in as I build up equity. I'll just keep tapping in, use my house as a piggy bank, and just keep extracting money from it. And if you it's nice when you're paying these credit card debt and so forth, you're paying these debts off. But another thing to beware of is, and actually creditors have a word for this, they call it reloading. When you just keep going and saying, oh, you know, I built up some equity. well, now I'm going to go borrow against that equity and then pay off this thing over here. And then I'm going to go borrow, when I build up some more equity, I'll take out another, and then I'll borrow against this thing and pay off this thing over here. You're running around borrowing more money. You're using debt to pay debt. And that's nice when you can say, like, oh, the credit card rate has this really high interest rate, it's not deductible and so forth. Well, be careful, though, that you're not just, living beyond your means and just constantly having to borrow more money just to pay off the money you borrowed before.